TICs and partnerships that most of us don't always encounter. Many entities are formed as TICs and partnerships, and but we do a lot of business with individuals. And so one of the things that I wanted everybody to learn is, okay, this is what a drop and swap looks like, and here's how you have to deal with it in the framework of an exchange. And so Toya was willing to do a presentation, and so I'm very pleased. Toya, you're in the spotlight.
Well, thank you, Cliff. So when you asked me to do this, I said, well, I don't want to talk about it. It's my least favorite topic, and I only make people unhappy. But actually, in the end, I rather enjoyed putting this together, and because I put into slides the kind of thinking that we go through with folks that are in partnership situations. So in fact, it's a pleasure to be speaking with all of you today.
So should we introduce everybody first? Let's do that.
I saw Brian there.
Okay, so let's go around. Abby, why don't you start, and then we'll go Abby, and then Patrice. I'll keep going. Keep going.
Okay. I'm Abby. A pleasure to finally meet you, Toya, virtually, and I'm the brokerage coordinator.
Okay, Patrice.
I'm Patrice, and I'm one of the brokers.
Tim.
I'm Tim Williams. I'm a broker and property manager for
Rick. Rick, unmute yourself. Rick, you're talking and you're muted, and we cannot hear a thing. All right, we'll skip Rick. There you go.
Okay. Yeah, well, Rick Funk, I'm an apartment broker.
There you go. Alessia?
My name is Alicia, and I'm investments and industrial.
Okay, Tamara?
I'm Tamara. I work in the residential department as the assistant director.
And broker. She has a license. Hey, Julie?
Yes.
Can you introduce yourself, please?
Hello. Okay. Investment broker, mostly multifamily.
Thank you. Stace?
Hi, Toya. Stacy, you know me. I'm an office broker. Nice to see you. Thanks for being here.
Jamie?
I'm Jamie. I run our commercial property management department.
And Brian?
Hi, Brian, hotels.
And Jim was here somewhere. Do we know where Jim went? Jim will probably reappear shortly. Jim Weirson, Alessia will track him down. All right, let's do it.
Okay, all right. So for those of you who don't know me, Toya Butler, of course, I am an attorney. You don't have to be an attorney to do the work, but I happen to be an attorney, and I've done this work now, well, since 1992, so do the math on that. And just kind of give a finger on the pulse in this office. Of course, we were hit with, you know, COVID, and April was a terrible month, but better than it might have been. We, in the last 3 years, have on average set up 100 exchanges a month. Well, we were just stunned that in the month of June, we set up 98. So that's the kind of volume we're seeing in the office, and it really runs the gamut, you know, single family rentals, ton of that, on up through the commercial stuff, which that's where we still haven't recovered yet, and I don't know when we will. You have a better idea than I do. And so these issues we're going to talk about today really are in this commercial context. It's where we see apartments, industrial, those properties are very frequently owned in a partnership of some sort. I want to remind you one thing, because we're going to start to see talk in Congress, and Biden in his tax plan. Buried in there, we understand that 1031, they want to get rid of it because they think about it being a tax-free, and it's a loophole, and why aren't those people paying their tax? If I may remind everybody that 1031 is a tax deferral. The tax bill doesn't go away. It just moves over into the replacement property. And I will say furthermore, in a study that was conducted, 88% of those new properties will eventually be sold in a taxable transaction. So although we talk about drop till you swap, I mean, exchange, or swap until you drop, exchange, die, 88% of those replacement properties that we purchase with clients are going to get sold subsequently in a taxable sale. So be on the alert that 1031 is a tax deferral. It is not tax-free. There are lots and lots and lots of rules around 1031 because it's tax law. So of course there are a lot of rules. We're not talking about any of those rules today other than, and we're ready to go to our next slide, a few basics that we need to talk about. Let's take a look here real quickly. I think, is it, who's moving my slides for me? It's Abby. Abby, if you, oh, there we are. Thank you very much. One basic rule that we have to talk about, 1031, it's now only for real property, real estate. It used to be we would do exchanges of equipment and aircraft and cars and cows. It is, oh, and you see at the bottom of that list, partnership, LLC property, LLC membership interests. If somebody is in a partnership owning a commercial property, the partner does not own real estate. The partnership owns the real estate. The partner, they own a partnership interest. They own a membership interest in that LLC. And today, for our discussion purposes, whether I use the term partnership or member of an LLC, they're one and the same at the tax, with the IRS, interchangeable. So it doesn't make any difference to our discussion today. Well, a slide or two later we'll talk about, it doesn't technically make any difference tax-wise, whether they're in a partnership, general limited, or in an LLC. Those inside of those entities don't own the real estate. It's a personal property interest, and we can't do exchanges of personal property interests. And your client is in a partnership or LLC, they think they own the real estate. Well, the IRS says otherwise. So we cannot do exchanges for anything other than real property. So next slide, another basic rule. The taxpayer that sells.
Hold on. I want to make sure everybody understood that concept.
I'll go. I talked too fast, and Cliff told me I only had 30 minutes, so I'm moving. Okay.
Well, you said you only wanted 30 minutes.
Well,
did everybody understand what she just said? Anybody have any questions that, in fact, the personal interest in the LLC is different than the interest in the real estate?
Yes.
Right.
Two different things.
If I understood it, then we'll keep moving.
Okay. Now, the next basic rule that we're going to talk about today briefly is the rule that the taxpayer that sells has to be the taxpayer that buys. So, using the same taxpayer ID. So if we have a partnership selling, then that partnership has to buy, and that tax ID needs to carry over for the deferral to work. So the fundamental that, or an individual sells, that individual has to be the buyer. Now they can be, we'll come to tenant in common in a moment, they can be a fractional owner, but they have to own real estate so that it shows up under their tax ID. So seller that sells has to be the buyer that buys. Ready for the next slide, Abby? Okay, now we need to define a few terms here. This is the boring part, but we do need to define a few terms here. What is real property? Would you believe that for my 28 years of this work, we've sort of made it up? Well, the rule really had been, it's whatever the state says. So each state, 50 states, we follow state law on what's real property. Well, we just got a ruling out of the IRS, a regulation, proposed regulation just last week that is changing the definition of real property at the tax level. It won't really change my work or yours, not really. But they did come out, the IRS, with their own definition of real property, and they won't be bound by the states. And so, but fundamentally, you know, real property is land plus improvements, plus the improvements. So that's the definition of real property for our purposes. Now, definition of a partnership or an LLC, which again are interchangeable in our discussion today. Doesn't matter to me or you which it is, it's one and the same at the tax level. So what is a partnership? A partnership, this is like common law. It's a relationship of two or more parties who join together to carry on a trade or business. A relationship. You don't hear documentation in there. It's just a relationship. They come together for this common purpose, business or trade, own real estate. That's partnership. Two or more come together. An LLC. Well, an LLC is a business organization formed by the legislature, frankly, created by the legislature. It's a business organization that allows partners to enjoy limited personal liability. But it's still a partnership because they're coming together for this common purpose, a trade or a business, interchangeable. But legislatively created, and there will be documentation for sure. Partnerships happen sometimes without anybody other than a handshake. We're going to do the deal. That sometimes is all we have to establish a partnership. The LLC, there will be an operating agreement and registration with the state and on and on. Now, what is tenant in common? Tenant in common is two or more folks who share the ownership of property. So now that's where you're going to typically see that on the deed. Well, let's you and I go together and buy together. We'll be tenant in common for owning real estate. It's not for business purposes. Partnership LLC is when there's a business activity going on. Tenant in common, merely the ownership of property, real estate. Next slide. Well, what if the relinquished property that you're about to list is in a partnership? Well, how can you even tell? Well, that's the question. So next slide, we're going to look at this. How do we even tell? Well, first of all, if it's an LLC and you see on title, you know, you've got a trio or something that shows a property profile that shows LLC owner. Well, you're thinking, well, then it's an LLC that owns. It should be easy. It's not easy. So here's the thing. In my real world, so many people, and Cliff alluded to this, so many people are going in and out of LLCs and creating LLCs for this and that, and they create them for single family homes and one thing and another because they want that limited liability. Well, did they even tell their accountant that they threw themselves into an LLC? I'll use the term, folks are kind of loosey-goosey about LLCs, and they don't understand that there's a tax implication. So if you see that they own the property you're about to list in an LLC, you think, well, it's an LLC. What we have learned, and this case that's cited there, and I'll explain that case in a moment, but what we learned from that case is just because it says LLC does not mean that it's an LLC for tax purposes. There's, first and foremost, your people didn't even bother to tell the accountant. So the accountant thinks that they're just tenant in common. Well, they bought it in tenant in common ownership originally, so they didn't tell the accountant when they threw it into an LLC for the limited liability feature. So the accountant doesn't know, and what the accountant, if they were told, the accountant is supposed to, with an LLC, where there's two or more parties in there, supposed to be reporting it as a partnership. On a partnership return, a 1065 with the IRS, and K1s. Well, they didn't tell the accountant, so the accountant didn't know they changed the ownership, so the accountant has not been reporting it to the IRS as a partnership like they should have. And so in those circumstances, if nobody told the accountant and there's no partnership return and there's no K1s, then you're about to list, we're going to have to ignore the LLC because you cannot make changes, and you'll see this as we go through, you can't make quick changes just before or just after an exchange. So can we tell if it's an LLC? It looks like it is, but maybe it isn't. This Gluck case, isn't that a name? Gluck came out just about 2 weeks ago. Oh, it's late May. And the other day, came out and told us that, you know, you gotta follow through on the form. And where Gluck was this. Gluck sold a property and as an individual, and then they went in as a tenant in common. And so on the title, it shows tenant in common, the ownership. But then Gluck got a K1. Gluck was in with a bunch of other folks, co-owned the property, thinking they're a tenant in common. They reported to the IRS that they owned as tenant in common. They'd gotten a K1. You only get a K1 when there's a partnership return for that property. And Gluck, you know, just blithely ignored the K1 they got and kept reporting it as tenant in common. They sold it as an individual, but in fact, tax-wise, they'd gotten themselves into a partnership. And this exchange failed. They sold as an individual, they're to buy a tenant in common as an individual. So you got to make sure that there aren't any K1s, there's no partnership returns going on there. And there were, and their exchange failed. So you can't even tell when they're an LLC if they're really in a tax partnership or not. Partnership, how can you tell if they're in a partnership?
Let me interrupt for just a second here.
Yes, sir.
Just for a second. So as Toya was pointing out, in an LLC, you get a K1. In a TIC, in a tenant in common, that what they do is they take the income and expenses and cut it up and give you a completely different form that has no semblance to a K1 at all. It's very confusing. It's confusing for CPAs. It's confusing for exchangers. It's confusing for attorneys, but the documentation is really loosey-goosey for TICs, in my opinion, as compared to LLCs. And if you're not doing it right, so usually what happens if somebody sells something, so first of all, remember that when you sell in an LLC, you're selling together as a group if there's 10 of you. And so you're moving from one property to another as a group. If you want to sell and buy something else, you can't do it out of the LLC. You're stuck. So with a TIC, so you have to do what's called a drop and swap, which Toya was talking about, ahead of time, where you split the LLC into TICs, and then you move individually in each TIC, okay? But usually that happens in the middle of the year, so you'll have, for your tax return, you'll have half of a year with a K1 and the half a year with gobbledygook that they send you, the accountants send you. And most people can't figure that out. So I'm sorry for interrupting.
No, that
I
was
just wanted
perfect. And it brings
clarify
up
that.
the point too, Cliff, that I know CPAs would prefer partnership returns in K1s. That's just easier on them. But if we've got
And their software, their software is not set up for TICs.
Yeah.
You're going to find there's very few CPAs that understand TICs.
Well, now partnership, we'll go to the next topic here. How do you know if they're in a partnership versus a tenant in common TIC? And we're going to get into some more detail of the points that Cliff was just making, these TICs in a moment, and how to break them up. But how do you even tell as the broker if they're in a partnership? You're seeing tenant in common on the deed, on the title report. Well, the thing is, you might not even see tenant in common, because the partnership, the state of Oregon, partnership property can be held as tenant in common. It can be held in the name of one or more of the partners. It doesn't even have to be held on title. It doesn't even have to show all of the partners. So again, it's just these people have joined up together, maybe a handshake. Sure, let's do the deal. You go on title, but we're all in this together. Then there's supposed to be K1s. Partnership returns with K1s. That's really the definitive answer. Are they filing partnership returns with K1s? Okay, so now next slide. Here we are. You're taking the listing of a partnership or LLC property. What I want you to do on your to-do list, when you're taking a listing of something that you can detect as partnership or LLC, please ask, what are they going to do when the sale closes? And if you hear anybody in there that wants to go out and buy replacement property, buy more real estate, then I think we're ready to go to the next slide. Anybody that wants to buy replacement property, we need to strategize sooner rather than later. So if you would, even before you list the property, ask that question. What are you going to do once the sale closes? People are taking cash, that's one thing. Anybody in there wanting real estate, we need to talk to them sooner rather than later. And thank you, Abby, for all the cute, she jazzed it up with all these graphics. It's pretty cool. Thank you. So we need to talk to them sooner rather than later. I want to be talking to them, even if it's a year or two before they're going to do the exchange. And although I'm an attorney and two others in here are as well, and we got a paralegal and all, even though you don't have to be, there's no billable hours for our time, even going through what I'm about to take you through. We need to educate them. We need to offer up strategies, and then they go back to their accountant and their attorney. But I want to be part of that conversation. So if somebody in that group, as Cliff said, if somebody in that group wants to buy real estate, well, they just can't go off and buy real estate and call that a 1031. Again, the partnership owned. The partnership buys, oh, but we just have one person that wants to do a 1031. That's not a match in the ownership. So what's my best idea? And that's our next slide. Idea number one, drop, and this is sort of what Cliff alluded to, drop out of the partnership in one tax year. So like here in July already, drop that one person out of the partnership now. This is my first, I think my best idea, my first idea, is you get that party out of the partnership now. So everybody else can stay in the partnership because they don't want a 1031. They're just going to take their money and pay tax. But drop out the one party that wants, or maybe that's a multiple and there's two want out. Point is, you drop out those folks that want a 1031 exchange. Do it here in July, like now. Don't let the accountant say, sure, we'll take care of that in December. No. We want them dropped out here in July. So for the first 6 months, they're going to get the K1, and for the next 6 months, they're going to get this, whatever you get when you've got yourself in a tenant in common. So that we'll season them outside of the partnership for maybe 6 months this year. And then, okay, once they're, for your purposes, once they're dropped out, then you can actually take a listing agreement and you can get a buyer. Now your seller is this partnership plus, let's say, this one outside investor. So you're gonna have two sellers, the partnership plus this party that's come out. Once they are dropped out here in July, then you can take your listing and you're gonna show your seller those two names, partnership plus the individual. Then you get an offer, purchase and sale agreement. And I would ask that that sale, you can be under contract this year, but I don't want that sale to close until, okay, January 2nd. I prefer a few more months into 2021. So that the point is they've owned their piece of this property outside of the partnership for at least a few months a year. We'd like them to own for a period of time after, into 2021, so that for 2 years, 2 tax returns that is, they're going to show that they were tenant in common outside of the partnership. So you drop them out of the partnership in one tax year, exchange in a subsequent tax year. This is the idea we're going to raise first if there's time. And we'll get this conversation in October, November, and they got to do a quick drop in November. And then you're going to list in December and get a buyer and close January 2nd. Well, okay, what have we done? At least got the drop out of the partnership on one tax return and the sale exchange on a different tax return. And why does that even matter? Because the IRS, well, okay, now 12 years ago, 2008, decided they wanted to track these and, maybe look at it, which they've never looked at these until the Glut case that just came out. They've never looked at these, but they did put a question on that partnership return. Did a partner, did the partnership distribute a tenant in common or other undivided interest to a partner? And then they've got to check a yes box. Yes, they dropped them out in July of this year. So they have to self-disclose that there was this drop in July, and that puts them in, if I would put it this way, a pool of potential participants in an IRS study, which has never come about. But they do have to flag themselves for the drop here this year. We want the exchange sale in a different year so that they don't draw the connection between the two. So that's my first idea, is to drop them out, which slows down your transaction. You're not going to have a closing for months now if they have the time to do this. So I want to talk in our next slide about the steps to liquidate a partnership. It's drop here in July. Well, here's what has to happen. They have to terminate the partnership. If they're all coming out, they terminate the partnership. This is a slide about liquidating a partnership. In fact, these are effectively still the same steps if you're just going to take one or two parties out. You might not liquidate, but you're just distributing out to certain parties. But these are the steps that still have to happen, whether it's a full liquidation or a distribution of just one or two of the members. So first of all, they have to terminate the partnership agreement. Or if it's some staying in, they're going to modify the partnership agreement. So that's got to be changed. That's an attorney has to do that work. They have to form the tenant in common arrangement, co-tenancy agreement. That's attorney work. So now if one person is coming out, the rest are staying in, they now have a co-tenancy agreement between the partnership that owns most of the property and the individual that's on the outside. That's an attorney got to do that. A deed records. An attorney has to prepare and get that recorded. Now you can see that none of that is rocket science. So truly, the attorney can get it done. This is July 1st. They can have it done by the end of the month. If everybody's cooperating. Oh, that's not one of the points on my slide. Everybody has to cooperate. The partnership has to let the one or two people out. And if people aren't trusting one another, that's where I get a brick wall often. Oh no, that's my sister. I can't trust her. If we let her outside the partnership, then she can hold up the whole sale. See how that is. So, but these are the steps if you're going to do it, client. Then, in this case, close partnership bank accounts. Well, if you were keeping some in, you wouldn't close them, but that co-owner needs to go in there and open their own bank account to take their proceeds, rent monies. They have to change the leases to show the partnership owns and the individual, or everybody's out, and in any case, the lease has to change, showing new ownership. They have to contact their creditors and change those accounts for the property. And I capitalize, they have to go in and modify the loan. Otherwise, it's a breach of the loan agreement. I'm sure it is. There was a case out of California where they did most of these steps, but they did not want to tell the lender, and there wasn't time anyway, so let's just go with it. And California disallowed the drop as a 1031 strategy because they did not go to the lender and modify the loan. And so as far as the lender was concerned, they were still in a partnership. And if you hold yourself out as a partnership to anybody in the world, you're in a partnership. And so they've got to go to the lender and modify. Well, there's another brick wall. Oh, it'd be a HUD loan, SBA, it's something that really can't be modified. We've just hit the brick wall. So they're supposed to go to the bank and get that modified. Then the CPA needs to file either a final partnership return here in July, not December, here in July, or if we're just dropping one out, the CPA has to stop with the K1s for that exited party here in July. Then here comes your part. Now you're going to take a listing agreement. It shows the couple of sellers or whatever our seller group really is. I want a clean paper trail. Their accountant wants a clean paper trail. So your listing agreement reflects this new ownership. The purchase and sale agreement reflects the new ownership. And then of course they deed out with tenant in common, that new ownership.
Let me interrupt for just 1 second, clarify for everybody. In the LLC, usually there's a managing partner, and the managing partner controls the investment. In a TIC, you have to vote on everything major. And so all of a sudden, instead of having one vision, which is what Toya was talking about, people can block each other and be obstructionist, depending on how the TIC documents are written. So switching from an LLC to a TIC is actually a really tricky business, and about the future of your partnership as a whole, even though all you're trying to do is step out of it, especially if you're doing it 2 years ahead, because people change their minds, they get hit by buses, all sorts of things happen. Different players end up on the field. So that's all I want to say. Sorry.
That was a great summation of the realities of coming out of that partnership. So anyway, that's what they have to do if they're going to do it right. And we want you to wait until they've done it before you take the listing agreement. So my first idea was if we have lots of time to season it out, but if we don't have lots of time, which is certainly the more typical conversation, they didn't call me well in advance, we're just hearing about it now. Well, here's my idea number 2. If we don't have lots of time, drop and at least season for a few months. So if your sale can't wait till January, can we at least drop here in July? They're outside of this partnership, let's say until November. And so the sale closes in November. So they at least have, what, 4 months where they're outside of the partnership. And there's a greater risk about it because the drop got disclosed on the partnership return. The 1031 gets reported on the same return. So greater risk about it. But like I said, at least the IRS isn't, other than that Gluck case, hadn't been looking at it. But at least gives the accountant something to argue. If they were to get audited, then they can say, no, my people weren't in the partnership, not for 4 months. So just season for a few months and get as much time in this tax year as you possibly can if the sale has to close this year. Idea number 3, if we have more than 2 partners in the partnership, instead of dropping out the guy that wants the exchange, drop out the people that want cash, drop those that want cash. So then when the sale closes, they just get their share of the sale proceeds. Nobody has to buy them out. But the people that want the exchange stay inside of the LLC. Honestly, there are like 9 different ideas in my head here about how we can deal with these issues. We're only going through like 5 or 6 of them today. And these are the ones that are most frequently utilized. And I like idea number 3, especially if we don't have a lot of time, especially if you've already taken the listing agreement and already have a purchase and sale agreement. So you have a listing for the partnership and again, partnership, LLC, interchangeable. You have a listing for the partnership. You've got a purchase and sale shows the partnership. And now we find out that 2 of them just want to, maybe there's 3 people in there and 1 wants their cash. And the other 2, they both want to do a 1031. So if more than 2 partners drop out those that want cash, we don't have to buy them out. Your people are always thinking, well, how am I going to buy them out? I don't have cash to buy them out. We don't have to have cash to buy them out. You get them dropped out. They're going to pay tax. You drop those that want cash out. So when we go to closing, you're going to have to amend the purchase and sale agreement to show the change of ownership of that property. You drop out those that want cash at closing. That's when they get their cash. They're a 1/3 seller, they get 1/3 of the cash, and 2/3 of the cash comes into the 1031 exchange. They stay together, they buy together. This only works if you have more than, this idea only works if you have more than 2 in the partnership, and you drop those that want cash and stay inside. So now the partnership sells and the partnership buys, and it's a perfect match. And idea number 3, I think, is a pretty solid idea. On to idea number 4. If Abby can move us over, there we are. Idea number 4. We'll use this a little longer. So idea number 4 is, what if we only have 2 partners in there? Not 3 or more. We have 2 partners in there. One wants cash. One wants the exchange. You cannot drop the one out so that at closing, they get their cash and the other guy stays in, gal stays inside of the LLC for this reason. If you have 2 parties in a partnership and one of them drops out, that breaks the partnership. And it's now a single member in that LLC, and it no longer reports under the old tax ID. If there's only one party inside that LLC, it's considered disregarded, right? We ignore that LLC when there's only one party in there, and it reports under their Social Security. Well, we had a 2-party LLC that sold, and now we have a 1-party LLC that's going to buy, and that's a different tax ID. It didn't match. Even though the name on the deed might match, LLC sells, LLC buys, at the tax level, it's not the same. So we can't just drop. So here's my suggestion. You drop the exiting partner out all but 1%. They stay in there, so we still have a 2-party partnership, LLC, but the guy that wants out is willing to stay in just 1%. So now we still have a 2-member LLC selling 51% of the property, and the one party selling 49%. They take their cash at closing. So they get their 49% of the cash at closing, 51% comes into the exchange, and we buy replacement property. And then next year, in a different tax year, the 50% owner in here figures out how to buy out the 1% owner. It's just 1%, so it's usually financially feasible to buy them out. So I love that idea. That idea works very well based on the new tax law that came out a few years ago. Just keep the one in, but just a teeny piece. Then we do our exchange, and this works beautifully when you've taken the listing as partnership, and you got the PSA as partnership, and now we find out that one of the guys, gals, doesn't want to do an exchange. They'll just stay in 1%. We're in a good place. Now moving on to idea number 5. Again, if we don't have lots of time, but if all want to exchange, cool, this works. So let's say we've got 3 people in there. They all want a 1031, but they do want to go their separate directions. So what we can do is buy multiple replacement properties. So 2 want to buy together, 1 wants to buy separate. We can go take, conceptually, 2/3 of the sale proceeds to buy 1 property owned by the partnership LLC, 1/3 of the proceeds to go buy a property still owned by the LLC. So the LLC sold 1, the LLC bought 2, and then in a subsequent tax year, they do a distribution out to each that really wishes to own those properties. Now, this is a very simplified scenario. There is work for the accountant. Well, one of those 2 properties is returning at a higher level, and one was a second home, or going to be a second home, doesn't hardly pay anything. They got to figure out how they're going to split the income from those properties in that next year. But that's a beautiful scenario. Stay together, buy together, multiple replacements, distribute out.
Wouldn't you have a tax return problem? Maybe, maybe not.
Well, there's
You could have 3 separate tax returns for each one of those 3 properties into the same LLC entity. So there you just have to be more creative on how you deal with that.
Well, you know, it depends on how they go in there and take ownership to those properties. For tax purposes, those 2 properties still do need to report under the original LLC. So they could set up new LLCs for each of those. Disregarded, though, the only member of that new LLC is the old LLC. It all flows back to the old LLC, still the same taxpayer ID, and the accountant can deal with it. This one works very well. Again, people have to cooperate. They all want to do an exchange, and let's just all do it. Multiple replacement properties. We do that often enough. And this is what we do usually when we're right up at closing and we find out, oh, you don't want to go together. Well, if you can just stay together long enough to buy more, and they were getting along. Wasn't a fight going on there, but they're just ready to go their separate directions. Idea number 5 works very well. Now, non-idea number 6. Anybody being dropped out of the partnership right at closing, they didn't own real estate. They owned a partnership membership interest. It's personal property interest. We cannot do exchanges of those. Well, trust me, and Chris knows this, for the first decade and a half of my career, what we did was a drop right at closing. Escrow prepared a deed from the partnership to the individuals, and those that wanted exchanges, we swooped in there and put paperwork together and did an exchange for them. Dropped them right at closing, took their money right at closing, and we did a 1031, and yeah, we got away with it. But we knew even then that it wasn't a good idea. And now we have far more clarity from the IRS here in just the last few months. 1031 is for real estate, real property ownership, not for membership interest. So did we think that a deed out to that party right at closing cured, got us around this prohibition against doing exchanges of personal property interests? Well, I never felt it was good, but we got away with it. So, however, having said that, if somebody is a gambler and wants to drop out right at closing and do a 1031 anyway, we'll do it. I kind of josh, but it is true. For our fee, we won't be at the audit. So, we'll do it, but we're not going to be at the audit if they get, challenged on it. Now, where is it a biggest issue? If you're working with anybody that's selling in California like this and want to buy in Oregon or wherever, California sales, boy, the IRS really, until this recent case, hasn't gone after it, but California most absolutely, certainly, positively is. And anybody dropping in California, that's an audit target for them, and they're looking for people dropping right at closing and trying to do 1031. But it doesn't work, but if somebody wanted to do it, we would certainly do it for them. And my next slide, which is to talk about, so that's the deal on partnership LLC, going in and out of them. A lot of brain damage, which is why it's my least favorite topic. And I'm not going to make people happy when I tell them, well, here's some ideas. And then they shoot down every idea. No. I've run out of ideas. So, but I had 6, kind of 5 anyway. Putting that aside, we do see these Delaware statutory trusts. I'm imagining that many of you have heard about these as a replacement property idea for people. So you've got an investor, property owner that really is done with real estate, all things considered. They're tired and they don't want to do it anymore. And my people that look at this product are at or near retirement. They're selling something they may have actively managed, or you've been managing nevertheless. They don't want to deal with it anymore. But they do not want to pay those taxes, but they are selling. So as an option for them, instead of going out with you and pounding the pavement and finding more real estate, these Delaware statutory trusts, DSTs, it's fractional ownership of real estate. It's a security. The way they're sold, they're real estate and they are a security. So your client is going to have to buy these, not through you, and you won't get a commission off of this. They're going to have to buy this through a financial advisor. Very few financial advisors have this product on their platform from their broker dealer. So most financial advisors don't know about this, don't understand real estate. So they don't offer this, but anybody wanting to go this route will have to find a financial advisor that does understand this, that does have it available, and will sell it. It is a security. Furthermore, your client and your clients they have to be an accredited investor, which means a certain net worth and a certain income or a certain income level. So it's not for my smaller investors with the little rental houses often. They will not meet the criteria as an accredited investor. These are sophisticated investments. They have to be at a certain level of income or net worth to get in on it. They are passive. And that's what your client is usually looking for, is passive. They're done dealing with it. So truthfully, they'll have no control. They won't even get a vote. Now, if they're in tenant in common ownership, Cliff mentioned, people can hang you up because they're tenant in common, everybody gets a vote. In these Delaware statutory trusts, they're passive, they don't even get a vote. The sponsor company, the that's running the show is going to make all decisions about the property. So it's not good for my younger investor that still wants to, move and shake a bit. They do come with replacement debt. So if you have people who need debt, these are designed to get them the replacement debt that's required for a 1031, which we did not discuss earlier on, those basic rules. Fifth point, they're illiquid. That when my client puts that money into that investment, the DST, it's fractional ownership of an apartment building in Texas or medical office in Utah or student housing in Ann Arbor. These are multi-tenanted typically. So illiquid, when you put your money in on this, they buy in, that money's locked in. They'll get their cash flow, their income stream monthly or quarterly from the property. They'll get their share of the lease payment, but they will not have access to the equity that went in there in the first place. It won't be available to them until that building is sold, which is typically 7 to 9 years down the road because the financing that's on these properties, 10-year loans or whatever. More typically, it's 7 to 9 years down the road when that asset sells, when the sponsor company decides. Then at that point, they have all of their options still available because going into the Delaware statutory trust, they still own real estate. The IRS has said so. So they still, at the time that sale comes along 7 to 9 years from now, they can do a 1031, bring it back to this market with you, buy something here if they didn't enjoy the DST ride. A lot of our people go in and they stay in because they're getting older. Well, now they're 77 instead of 70, and now they're 87 instead of, so they're staying in those for the most part from what we see, but they don't have to. They can bring it back here, invest, stay in the DST, take the money and pay tax. So they have all of their options still available out of these Delaware statutory trusts. And out of that typical 100 exchanges a month that we see, 2 to 4 of our clients will go in to the DST, because most of my clients are maybe like yours. They're, they've held these assets a long time. They're in their late 60s, 70s, and 80s. And so this becomes attractive to them. 2 to 4 a month will go this route. And the last slide, oh, not quite the last slide, questions. Oh, that is very well done, Abby. I like those question marks.
Thank you.
Questions from the group. I don't know. Was I thorough in my presentation?
Mm-hmm.
So, most importantly, really, is one of those slides in the middle about calling us as soon as possible. And we will hold this conversation with your client, and I will talk with them over, and the team will, over days, weeks, months, years, until they finally get to the point where 1031 is, or if they ever do. Half of the calls we get won't even turn into a 1031. So what I want you to know is we're a resource, absolutely, for you, for your client, for the attorneys and accountants in town, the financial advisors, truly anybody that has questions should feel free to call us. It is actually the fun part of what we do in here. There's our contact information. Thanks, Abby. It's the fun part of what we do. We only, like any other exchange company, get paid flat rate fees if and when somebody has an exchange. So that's what we get paid for, the documents in these closings, because what we're paid for is our paperwork in the closing for the sale, in the closing for the purchase, creates the 1031. They've got to have us for that. That's what we get paid for, and we have to hold their money. But being a resource for them, and that's just the satisfying part of this work, and why I and these other attorneys keep doing it. No billable hours in here. It's just every phone call for us. Every phone call for us is another bar exam question. And I won't say we enjoyed the bar exam, but we just have to peel that onion apart and see where we can get to something that works for the client. Honestly, half the time, your client will decide it's not going to happen for them. 1031 doesn't meet their goals or their needs. And we're mostly looking to achieve whatever is their goal or their need here. Is it a business goal? Is it a personal goal? Can we get there with 1031? And truthfully, half the time, no. There's so many rules that we help them navigate. So with that, I ran over time, Cliff. I'm sorry. Oh, I see clapping. Thank you.
Yeah, that's okay.
Yeah.
That's okay.
1031 is my favorite topic. Partnership is not, but this is fun putting this together for you. So thank you for the invitation.
Thank you so much, Toya. That was actually really helpful, I think. Not I think, I know.
Well,
and pretty high level, really, especially for people that are doing investment transactions. This is also good for Tim and Jamie to understand how their ownership levels are structured tomorrow, because it does make a difference, and you have to be able to give your clients advice on what to do next. So I hope that you guys, as a matter of fact, we've recorded this and this is available and the slides are available as well, correct?
Yep.
Abby, so you can send the slides to everybody.
Yep. I'll get
And that'd be good. And of course, call Toya with questions or her team. Do you want to tell us who your team is real quickly?
Oh,
To
yes,
other attorneys if you're not available?
So two other attorneys in this office are Mark Adams. He's got a stronger tax background than I do, I'll say that for sure. And then we have Kelsey Paiva, and Kelsey's been with us now, oh, I've lost track of time, 4 or 5 years. She's an attorney as well, paralegal. And then Karen Inabnet is not an attorney, just should have gone to law school, didn't do it. And she's been she's been doing this work 25 years, 20 with me. So she has the very same kinds of answers that any of us would have as well. And with her time in the trenches. So what was I going to say? There was something I was going to say in these slides and this information. When somebody calls me with a partnership question, I actually can't give an answer until I've asked a ton of questions like who wants what, when, where, why, and how. And then I'll pull out of my brain which of these ideas might be useful. So you're not expected, of course, to send this over to the client and say, here, figure it out yourself. No, there's a couple of other ideas in there that I haven't brought out, but they're more complicated. But this is just kind of gives it to you in the black and white.
Strategy, yeah, some strategies. Always very helpful strategies.
There are strategies out there. Whether they work for the client or not is to be determined.
Right, great.
Okay.
Any other questions, anybody? Hearing none. Thanks again. Round of applause. We really appreciate it, Toya.
A pleasure.
It was very, very helpful.
Talk to you later.
Okay, take care. Thank you. Bye-bye.